I absolutely, without a doubt, guarantee you that stocks will fall and they will fall hard. The question is, will you be ready to win while everyone else is panicking? Now picture this. Headlines everywhere. Markets are down 30, 40, 50, 60%. Stocks are free falling. Investors are panicking. Chaos everywhere. No news is helping. Good news is bad news. Bad news is even worse news. It's happened before, but most of the people in this market right now have not experienced that. And most people will sell and lose, but not you. Because today, I'm going to show you how to turn that chaos into the greatest financial opportunity of your lifetime. Right now, investor confidence is absolutely skyrocketing, and it's at the highest level since 1988. Look at this, guys. This is the share of consumers expecting stock prices to rise over the next 12 months. Guys, the 2000 bubble was right here, about 47%. We just eclipsed about 56%. You might sit there and say, well, it's not that big of a difference. Guys, this is a huge difference. Now, here's what's interesting. The lowest levels, financial crisis, this wasn't really that low, COVID, because it was so short. And you look here at the tech crash right here. This was the bottom of the market. Guys, we want sentiment to be bad. When sentiment is bad, people are selling. When you sell, stock prices fall. Valuations get better. On this channel, we're trying to teach principle-driven investing. One of the major attributes is we don't let the price of stocks tell us if we're right or wrong. We look at it as relative to value. Junk bonds are priced as if risk doesn't even exist. It feels like nothing could go wrong, but that's exactly the problem. Investor optimism is at this highest level, and that's not confidence, that's complacency. And complacency is dangerous. Now, guys, not every investor sentiment is this bad. Let me show you another one that's very popular and show you that it's high, but it's not as high as this shows. Now, this is the bullish to bearish sentiment on the Investors Intelligence Survey. We're still at this point right here currently. That's what this dotted line is. And back here in 2018-19, we were higher and things still kept going up. And that's the thing about bull markets. That's the thing about complacency. That's the thing about euphoria. You don't know when it's going to end. Look at Bitcoin, $108,000 per coin. Guys, I see zero intrinsic value in Bitcoin in its current state. And yes, I know people are going to argue and say, Paul, it's just because you don't get it. Guys, that's funny to me that every single time I hear Warren Buffett, Howard Marks, Seth Klarman, Charlie Munger, all these brilliant people talk, when people disagree with them, they don't say you just don't get it. Yet then when some 19-year-old kid who can program a computer looks at Bitcoin and says it's the future, and he looks at me and goes, you just don't get it, I think to myself, who doesn't get it? Another sign of complacency. Now, I talked earlier about junk bonds. Guys, what is a junk bond? Well, there's certain levels of bonds that get rated. Under a certain level, corporate junk bonds are considered higher risk. They have more risk of bankruptcy, more risk of default, things like that. The spread between junk bonds and the risk-free rate with the government as of September 30th was 3.03. It got as low as 2.7%. The historical average is about 5.33%. That's almost half, guys. That spread is almost half. So you might sit there and say, well, big deal. What does that mean? Well, guys, let's think about it this way. You have good credit. Your friend doesn't pay their bills. They have bad credit. So when you guys go buy a car, who gets the better interest rate? You do. But in this situation, what's happening here is, as time goes on, the banks get so excited to give money out to people because money's so plentiful, they start charging a rate to your friend who doesn't pay his bills very close to yours. Are they factoring in the risk? They're not properly factoring in risk, and that's what creates crashes. When people don't factor in that the downside is far greater than people realize. Now, I'm going to repeat several times in this video. I don't know when. No one knows when it's going to happen. Euphoria can last years. I've been looking at this thing, and I've been wrong in terms of valuation for a while. I bet against euphoria. I bet against NVIDIA. Big mistake. But that wasn't investing, that was speculating. And I'm really, really glad I learned that lesson very early. Markets can stay irrational longer than you can stay solvent. So how overvalued are markets? Let's take a look. This is the stock market to GDP ratio going back to 1928 that I created. Now, Warren Buffett, he calls this the single most reliable metric of stock market valuations at any given time. And of course, I've seen tons of criticism of this. And here's a spoiler alert. That criticism has come in the last few years. Why? Because this has shown how overpriced we are. It calculates by taking the total stock market market cap and dividing it into GDP. We're currently at 121% overvalued. Guys, as a comparison, back in 2000 in the tech bubble, we got to about 55% overvalued. We're over double the overvaluation from 2000. Now, a lot of people sit there and say, well, money made in the US today, made overseas, it's not counted here, blah, 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 blah. Fine. There's a second ratio, the 10-year cyclically adjusted PE ratio. It takes the last 10 years of S&P earnings, brings it to today using inflation, so brings it into today's dollars, and divides the market cap into that. We're currently at 38.54. Historical average, 17.17. We're 124.5% overvalued. That's even higher than the stock market GDP ratio. Guys, any way you cut it, people are paying more for a dollar of cash flow today than they ever have in history. Now, let me ask you a question. If you pay more for something, are your returns going to be less or more? They're obviously going to be less. This phone is worth $1,000. If you paid $900 for it, you're going to make $100. You're going to make 11% of your money, 100 divided by 900. If you pay $500 for it, you're going to sell it and make another $500 in profit. You're going to make 100% of your money. Same phone, same everything. The future is unknown. We don't know what these companies are going to generate, but their stock prices aren't going to dictate how much money they make in the future as an operating business. If you don't believe that, go look at Intel, Cisco, Micron, Apple, Microsoft, Google, all these companies. When their stocks fell, guess what happened to their profit? It still kept going up. And even with Intel, a company that's struggling right now, it is 66% lower than the year 2000, and its revenue and profit is much greater today than it was back then. Cisco, same thing, several times greater. But what happened? People overpaid. That's what's happening here. You're paying too much for a future stream of cash flow. Now, you might be sitting there saying, Paul, you've been saying this for a long time. I have been. And don't forget, we have made accurate calls on bubbles in the past. EV stocks, cannabis stocks. Everybody told us we didn't get it. EV was the future. When was the last time you heard somebody say EV was the future? I'll tell you when, about 3.5 years ago. And all those companies went to zero. Remember Tattooed Chef? Paul, you don't get it. You have to understand the company and what it's going to do. Cool, went to zero. Why? Because people paid too much and the company wasn't fundamentally strong. Remember one thing, just because there's a future that's great for a company or an industry doesn't mean the company's going to do well. In fact, I think I heard a stat from Warren Buffett where he said overall in the car business, since the car business started over 100 years ago, there's been a net loss of investment dollars. Even though we have how many cars in this world? Every single year, 51, 52 million new cars are sold. And yet you still overall, have you invested in these companies all along the way, would have lost money, even with all these major increases. Which brings us to Tesla. Tesla and Bitcoin are, I believe, the poster children of this bubble. Why? Because Tesla is being told it's not a car company, even though actually over 90% of its revenue comes from car sales. And two, because Bitcoin is a asset with no intrinsic value that generates nothing, and yet people are paying for it. They're sitting there so far as to say, you should make money in fiat and buy assets like Bitcoin. And I'm like, oh my gosh, this is unbelievable. And to those Bitcoiners out there who say you don't get it, Paul, you don't get investing. That's the fact. You don't understand investing. This is pure speculation. And that's okay. Speculation is fine. But when you confuse speculation and investment, that's when trouble happens. And guess what? Trouble might be kicked down the road for a while. After all, Bitcoin was only $3,000 just a few years ago, and now it's over 100. It hit 108,000 and change today. Now, guys, I'm talking a lot of fear here. That's not the case. The reason I bring this up is to say to people, guys, if you've been spoiled by the last 5 or 10 years, it's okay. I was spoiled 25 years ago, and you learn the lessons, and it makes you better because of it. And also, it's an opportunity, because the thing I didn't know 25 years ago was that every bear market, every crash is an opportunity. Look at it this way. QQQ is the NASDAQ 100. From the peak in 2000 to the bottom of 2003, it fell 83%. 83%. But guys, if you literally started dollar cost averaging into QQQ at the peak of 2000 to today, your annualized returns would have been 15.3%. 15.3%. Even though QQQ's only done like 7 to 8% from the peak till now. That's incredible. That's the power of dollar cost averaging. That's what I'm trying to teach. I'm trying to teach you the idea of saying, listen, avoid the hype, avoid the junk companies. NVIDIA is not a junk company. NVIDIA is a phenomenal company. But if you pay too much for it, it could end up being a bad investment. That's what we're trying to teach here. It's not about buying good things. It's not about buying good companies. It's about good companies being bought at the right price. If you're not doing that, you're speculating. We need to put the story and the numbers together to make a successful investment. If this makes sense to you, you're at the right place. And it'll always be better in the long run. If you're just the person who likes the dollar cost average and the low cost ETFs, wonderful. But I want to remind you, when things look terrible, when markets are falling like crazy, when all these things look like stocks are going to zero, just remember, stocks don't go to zero. What would have to happen for stocks to go to zero? For the entire stock market, not just one or two companies, for the entire stock market to go to zero. Think about what would have to happen. Nuclear war, devastation, asteroid hits the earth, all these things that would happen. And guess what? What I would tell you is, if those were to happen, your money means nothing anyway. So you may as well be buying on the way down. Dollar cost average and a low cost ETFs, and you will do very, very well. But it'll be hard after a while, seeing stocks go down, seeing other things go up like crazy and say, well, I'm going to sell these and go into those. Don't chase that hype. If you want to chase that hype, do it with extra money. Don't do it with the money you need for retirement. Stick to your plan. It'll do very, very well. But I want you to remember, markets always correct. That's what makes an average. It's not if, it's when. The question is, what will you do when that happens? Here's what most people do when markets fall. They panic. I have 1,000 stories about this. And it's even scarier to me now when I hear friends saying, well, if stocks fell in half, I'd be fine with that. I'd buy more. I've heard that. I heard that like crazy in 07, 08. Guy Spear wrote a great book called The Education of a Value Investor, in which his value investing friends gave up. And his comment was, but this is what we're waiting for. And they said, well, no, but I can't stomach these losses. It's different this time. Guess what? It's not different on the up, and it's not different on the down. They sell their stocks at a loss, and they quit investing entirely. They blame the system. They blame some news. They state things like, the market's rigged. I'm done with this. But here's the truth. Every market crash is an opportunity to buy stocks at a discount. Think about it this way. In 2008, during the financial crisis, you could have bought Apple, Amazon, or Microsoft at prices you can't even imagine today. Those who stayed disciplined and bought during the panic didn't just recover, they built life-changing wealth. Every crash in history has rewarded those who were prepared. The next crash, it could be the greatest opportunity of your life, but only if you're ready. Not just with money, but emotionally, with knowledge. So how do you prepare? First, take an offensive mindset. Most people panic when stocks fall, but you'll see it as a buying opportunity. When others are selling, you'll be buying. Second, stick to your plan. The best prices come when everyone else is afraid. When everyone else is bailing, that's what causes prices to fall. Don't let fear pull you off track. And third, you need to surround yourself with people who won't quit. You need to understand that there are people out there who get this. You need to surround yourself with them, because the hard truth is this. When the next crash happens, everyone around you, your friends, your family, will panic. They'll sell their stocks. They'll tell you to do the same. They'll tell you you're crazy. To which I would say, so wait a second. The NASDAQ at 20,000 made sense, but the NASDAQ at 10,000 doesn't? Come on. But you need to align yourself with people who see opportunity, not fear. That's hard to find, because fear works out there. That's how you stay focused. That's how you win. Now, obviously, at this time, you understand the warning signs and the mistakes most people make when markets do crash. But here's the good news. You don't have to go through this alone. This is exactly why we created everythingmoney.com. When the next crash happens, and it will, you'll need the right tools, mindset, and support to turn that into an opportunity. And here's what you get with our community. These are the tools I use every day to analyze stocks, analyze real estate, find opportunities, and make less mistakes. A group of like-minded investors who keep buying when everyone else is panicking, and the confidence to make smart decisions when the market is falling. This community of thousands of like-minded investors talk every single day, and the best part is, when markets are red, they're the most excited. That's the kind of group of people you need to surround yourself with. And right now, we have a great 7-day trial offer, $7 for 7 days. Click in the link in the description below. Join today because the next market crash absolutely is coming. The only question is, will you be ready to take advantage of it? Thank you for your time.